Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Redcat.
If you find our talks useful, please consider subscribe, like, and comment underneath. And today I was looking through some preliminary data for the defense tech sector, and a specific set of numbers just completely caught me off guard.
Oh yeah, it's an absolute jaw-dropper.
Right. We are looking at a situation today that is just demanding the market's attention because it involves a staggeringly massive revenue growth trajectory. I mean, imagine opening up your portfolio, diving into a company's financials, and seeing a fourth quarter revenue jump of roughly 1,842% year over year.
It honestly sounds like a typo when you say it out loud.
I had to double check that figure just to make sure my screen wasn't glitching. Almost an 1,800% jump. That is the current reality for Redcat right now. And it is sending absolute shockwaves through the entire defense tech space.
It is, but, those numbers are incredibly flashy. And for anyone listening who is focused on building sustainable wealth, we really have to look past that initial top-line spectacle. Because a massive percentage jump doesn't automatically equate to a sustainable, profitable business. So the mission for us today is to understand the actual mechanics of how a defense technology company scales across all these operational domains.
Air, land, and sea.
Exactly. We need to dissect what the underlying financials look like beneath that explosive top-line growth and ultimately determine whether the upcoming catalysts make this a viable multi-year wealth-building opportunity for your portfolio.
Because in the defense sector, top-line revenue is really just the opening chapter of a very complex story.
Precisely.
So let's unpack that opening chapter. The raw, unaudited data we are analyzing paints a picture of a company moving at warp speed. For the fourth quarter of 2025, they are projecting revenue between $24 and $26.5 million.
Which is a massive leap.
It is. And when you zoom out to the full year of 2025, the expectation is to land somewhere between $38 and $41 million. To put that in perspective for you, that's roughly 153% higher than what they did in 2024.
Yeah.
But the part that really made me pause is the forward projection. Analysts are eyeing a $60 million run rate for 2025 and then projecting a massive leap to $125 million in 2026. How does a company of this size even begin to prepare for a leap to $125 million?
Well, they prepare by spending a massive amount of capital. And this brings us to a pretty serious reality check. When you lift the hood and look at the trailing 12 months ending in September 2025, the profitability metrics tell a very sobering story.
Yeah, they do.
The earnings per share sits at negative 77 cents. Gross margins are sitting at roughly negative 38%. But the number that really jumps off the page is the net profit margin, which is hovering around negative 1,200%.
Yeah, negative 1,200%. Just to visualize that for a second. That essentially means for every single dollar they bring in the door, they are spending $12 to operate and grow the business.
Right.
For a traditional value investor, seeing margins that deeply in the red would be an immediate, glaring red flag. You'd look at that and assume the business is just hemorrhaging cash with absolutely no bottom in sight. Why would anyone managing their own investments touch a stock with a cash burn that intense?
Because it requires a completely different analytical framework. In the hardware and defense tech space, negative margins of this magnitude aren't necessarily the death knell they would be for, say, a traditional retail or software company.
Ah, okay.
What we are seeing here is incredibly aggressive research and development reinvestment. Management isn't taking the cash from their recent program wins and artificially inflating the stock price with buybacks.
Or paying out those safe little dividends to keep investors quiet.
Exactly. They are pouring essentially every available dollar into scaling their manufacturing footprint and pushing aggressively into new domains, specifically the maritime space. Think of it like a major automaker building a $5 billion gigafactory. The balance sheet looks terrifying while the concrete is being poured, but they are positioning for massive scale before the assembly line even turns on.
That makes a lot of sense. So the terrifying cash burn is actually a deliberate strategy to build capacity. But they're clearly betting the farm on securing government contracts to eventually fill that capacity. And the defense sector is notoriously difficult to break into.
Very difficult.
It's basically an old boys club dominated by legacy aerospace giants.
So how is a company like this actually getting the Pentagon's attention, let alone projecting a jump to $125 million in revenue? What is the actual product that the government is buying so eagerly? Well, the product is really just one piece of the puzzle. The real value is the ecosystem they've built and the regulatory moat that protects it. The foundational piece of their entire strategy is what's known as Blue UAS certification.
Blue UAS.
Right. For anyone unfamiliar with the defense space, think of Blue UAS as the Department of Defense's ultimate VIP whitelist. It guarantees that the technology is secure and entirely free of compromised foreign components. If a drone isn't on this specific list, the U.S. military legally cannot fly it.
That is a massive barrier to entry.
It is the ultimate barrier. And Redcat operates primarily through three core subsidiaries that hold this clearance. You have Teal Drones, FlightWave, and Blue Ops. By integrating these three companies, they've created an all-domain operational capability.
Do they cover everything?
Everything. Up in the air, you have their Black Widow drones, which are designed for intelligence, surveillance, and reconnaissance. Down on the water, they're rolling out the Variant 7 unmanned surface vehicles, or USVs.
And just to translate that for a second, a USV is essentially a highly advanced autonomous speedboat packed with sensors and tactical gear.
Yes, so a military commander out in the field doesn't have to piece together a fragmented defense system from 5 different contractors. They can operate a seamlessly integrated swarm of air and sea drones from the exact same US-made ecosystem.
I like to think of it almost like the Apple ecosystem, but for warfare. Your airborne drone talks perfectly to your aquatic drone because they run on the same natively integrated, secure operating system.
That's a perfect analogy.
And that secure U.S.-made aspect is the crucial lever here, especially when we dive into the legislative tailwinds. Because the biggest macro driver we are analyzing right now is the Federal Communications Commission's immediate implementation of a very specific piece of legislation.
The fiscal year 2025 NDAA Section 1709.
Exactly. Let's break down what the National Defense Authorization Act actually means for your portfolio in this context. This legislation explicitly bans the use of foreign drone components by U.S. agencies. Think of it as a federal ban hammer on cheap overseas parts.
Which fundamentally alters the competitive landscape overnight.
Overnight. It instantly handicaps foreign competitors or even domestic competitors who rely on cheaper supply chains abroad. This hands U.S.-made drone manufacturers immense pricing power. It creates a clear, undeniable procurement edge over rivals in the commercial and tactical space, like Draganfly.
Right.
When the U.S. government legally cannot buy from your cheapest competitors, your addressable market doesn't just grow, it gets handed to you on a silver platter.
It is a literal government-mandated competitive moat, and we really have to analyze this within the broader macro environment. Currently, we are observing heightened U.S., Israel, and Iran dynamics alongside ongoing conflicts in multiple global theaters.
Yeah, the global landscape is tense.
It is, and from a purely impartial market analysis standpoint, leaving all political stances completely aside, these geopolitical tensions are inherently boosting global defense spending. Nations are rapidly modernizing their forces because the very nature of conflict is changing.
The capital flow is moving swiftly and directly toward agile, unmanned systems.
Exactly. That macro environment directly feeds into the pipeline for domestic, secure, combat-ready drones. The demand is quite literally higher than it has ever been in modern history.
And we saw that exact momentum fully on display during the company's recent Innovation Day on March 1st. I was looking at the fallout from that event, and the market response was electric. It happened right alongside their Pentagon drone dominance contract win, which serves as a massive validation of their technology at the highest levels of government.
Huge validation.
Add to that the excitement around the new U.S. Army Short-Range Reconnaissance, or SRR award. When the Pentagon and the U.S. Army are both validating your tech in the same short window, institutional investors are going to pay very close attention to your next move.
They definitely are. But the true insight from that Innovation Day wasn't just about the drones themselves. It highlighted a fundamental shift in their entire business model. And this connects directly back to that projected 2026 revenue of $125 million. Well, what's driving the confidence in that massive projection are the specific partnerships accelerating their maritime expansion. Just a day after Innovation Day, on March 2nd, they announced a critical partnership with Allen Control Systems. The plan is to integrate Allen Control Systems' Bullfrog counter-drone technology directly onto the Blue Ops surface vehicles.
Oh, wow. So they aren't just building the hardware anymore. They are becoming platform integrators.
Precisely. You no longer just have a surface drone passively observing the water. You have an autonomous surface vehicle actively equipped with advanced counter-drone systems capable of neutralizing airborne threats.
That is multi-domain warfare tech coming to life.
It really is. They are transforming from a drone maker into a comprehensive weapons platform integrator, which expands their potential customer base exponentially.
And we are seeing evidence that the customer base is expanding globally, not just domestically. The stability in their cash flow isn't solely reliant on the U.S. military budget anymore. We are tracking recent Asia-Pacific Black Widow sales that are already scheduled for delivery in 2026.
It is huge.
For you as an investor, this is exactly what you want to see. A predictable cash flow runway. It proves the tech isn't just reliant on a one-off domestic government grant. It has real international adoption. And naturally, when a company secures a tender in the Asia-Pacific region, it sparks very credible rumors of broader international deals to come.
Because allied nations talk to each other.
They train together, and they tend to buy interoperable equipment.
And that predictable runway and international validation is exactly what the market is trying to price in right now, which leads us perfectly into the price action, the volatility, and the overall market sentiment. Because the chart for this stock has been nothing short of explosive and, quite frankly, highly erratic.
It has been a wild ride. Let's break down the recent market mechanics, because the volatility here is intense. And if you aren't paying attention, it can absolutely shake you out of a position. Year-to-date in 2026, the stock has surged over 60%.
60%.
Just in late February, it saw a 12.4% weekly gain. And then, right after that Innovation Day and those partnership announcements, on March 2nd alone, the stock jumped almost 20% to hit $13.93. And it did this on skyrocketing volume. This wasn't a quiet, creeping move up. This was an aggressive surge with heavy institutional volume backing it up.
That skyrocketing volume tells a distinct story about how the big money is viewing this sector. When you look at the analyst sentiment driving this, the top catalyst currently is Needham reiterating a buy rating and attaching a $16 price target to the stock.
And we need to explain why that matters.
We do. When a respected major firm puts a $16 price target on a stock currently trading in the $13 range, it acts as a literal magnet for institutional flow. Algorithms and institutional funds that track analyst-rated stocks suddenly get the green light to buy in.
Right. It triggers automated buying.
Exactly. We are seeing a broader market rotation where capital is moving out of overheated, purely speculative software AI and rotating into tangible tech and defense hardware. Institutions are moving into this stock because they see the government contracts providing a solid floor, while the multi-domain technology provides a massive ceiling.
I completely see the appeal of that bullish setup, but as with any wealth-building strategy, we cannot only look at the upside. We have to be disciplined and look at the risks. And there is a very real fear factor, a strong bear case, that we need to unpack here.
Definitely.
Just a few days prior to that massive March 2nd run, on February 27th, the stock actually took a hard dive. It crashed due to broader market weakness, but more specifically, it was dragged down by dilution fears. Interestingly, these fears were triggered by concerns over a peer company in the defense space, Kratos.
Oh, right, the Kratos situation.
Yeah. Kratos faced some operational struggles. The market got spooked about the sector's overall cash burn, and the algorithms just dragged everything in the defense tech space down with it in sympathy.
And that sympathetic crash raises an incredibly important question about fundamental financial health. It ties right back to those negative margins we discussed at the start of our analysis. The company currently operates with a debt-to-equity ratio of 5.4%.
Now, 5.4% might not sound dangerously high for a mature, profitable blue-chip company.
Right, but for a tech company burning cash at a 12-to-1 ratio just to build manufacturing capacity, it creates a very specific risk profile.
It essentially becomes a ticking
clock.
Exactly.
That is the perfect way to look at it. If their growth timeline gets delayed for any reason, say a major contract gets pushed back a few quarters in the Pentagon's infamous bureaucracy, or a supply chain issue stalls the manufacturing of those surface vehicles, there is a very real mathematical risk of shareholder dilution. The company would be forced to issue new shares to raise capital just to keep the lights on while waiting for the promised revenue to actually hit the bank account.
And if you are a shareholder, dilution is the absolute enemy of your returns. Your slice of the pie gets smaller just to keep the bakery open. We also have to note that consensus revenue estimates were recently cut by 20% ahead of their upcoming audit.
Which is a significant haircut.
It is. So while the long-term analyst price targets like Needham's are rising, the short-term revenue consensus actually took a haircut. It creates a highly volatile setup where the market is constantly balancing the harsh reality of current cash burn against the massive promise of future contracts.
Which is why timing and catalysts are absolutely everything for managing a position in this stock right now. You cannot just buy and ignore it. As an investor, you need a clear, data-driven action plan.
Let's lay out that timeline and map out the catalyst calendar so you know exactly what to watch next. Mark your calendars because the most critical upcoming date is March 18th, 2026. This is when the Q4 and full year 2025 earnings officially drop.
The moment of truth.
Exactly. This is where all of those preliminary, unaudited numbers finally face the music.
When you listen to that earnings call on the 18th, here is exactly what you need to focus on. First, you need absolute confirmation of that $24 million plus Q4 revenue beat. The market has already priced in the preliminary success we talked about, so any downward revision or accounting adjustment there would be punished severely by the market.
Oh, without a doubt.
But crucially, the most important part of that call will be the forward guidance. You want to hear management provide upward revisions or... So when we synthesize all of this data, the fundamental explosive growth projections, the regulatory moats provided by the NDAA, the macro environment driving global defense spending, and the very real risks of high cash burn and potential dilution, where does that leave the final investment thesis?
When we aggregate the analysis, we are assigning this an 8 out of 10 bullish score.
Which feels appropriate given the massive tailwinds.
Exactly. The elevator pitch for your portfolio is this. You are looking at an opportunity to capitalize on massive, NDAA-driven U.S. drone dominance. You have a company expanding rapidly into multi-domain growth across air and sea, acting as a platform integrator and backed by explosive 1,800% revenue growth targets for the recent quarter.
It's a compelling setup.
The horizon looks incredibly prime for a strategic swing trade leading right into those Q1 2026 earnings, trying to capture the momentum of the Needham $16 price target. Alternatively, if you can stomach the wild volatility and the ever-present dilution risks, it presents a fascinating multi-year hold as these defense contracts finally scale and the manufacturing capacity catches up to the massive R&D burn.
Keep your eyes locked on that March 18th catalyst.
Stay incredibly disciplined with your risk management, stay informed, and most importantly, keep building smart wealth. See you next time.
And as you analyze your own portfolio and watch this sector evolve, I want to leave you with a final provocative thought to mull over. We are currently watching the theater of warfare fundamentally transition in real time. Global militaries are actively moving away from massive billion-dollar traditional legacy assets.
Like vulnerable single fighter jets or massive destroyers.
Exactly, and they are shifting heavily towards swarms of agile, expendable multi-domain drones. It is a complete paradigm shift in how nations project power. If a company successfully bridges the dangerous gap from burning massive cash on R&D to achieving true manufacturing economies of scale in this new era of decentralized defense, how does that permanently rewrite the way Wall Street values the military contractors of the future?